War has broken out. Should I hit the panic button? Gold is at an all time high. Is it time to load up on gold? If markets are falling, who's actually losing money? Nobody is talking about their FDs right now. Should you be? Should I actually do anything this week given the scenario? Hello and welcome to Investors Hangout, your weekly guide to making smarter investment decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, gold ETF inflows overtook mutual fund inflows for the first time ever. Crude passed $85. Sensex is down about 3% this week. And whenever markets move like this, investors start panicking. So today, let's look at 5 questions that separate useful action from expensive panic. And to get all these answers, we have with us our in-house expert, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Let's begin this conversation with the war, which has already started. Should I hit the panic button?
War is like a stress test. It's not a death sentence. It's not the end of the world. Everybody is thinking that this war and everything is coming to an end. Oil prices going up, that's one supply fear. Gold prices going up, that is the psychology. When everybody is fearful, they run towards gold. And equities dip on uncertainty. So I think, the context is very clear, and bonds rally because everybody wants to take the money out and be risk averse and park it there. So this kind of, something extraordinary happens, and this was not even unexpected. This is not even unanticipated. We have been warming up to these kind of geopolitical changes, and it started with Ukraine when it came on the forefront. There's this Carson's Group study where in the last 85 years, 40 wars, and market has tanked on all these occasions. And it has taken anywhere between something like 1 month to 3 months, and the market has gone up. Market recovers. In fact, many a times there is a hypothesis that post-war, the economy actually thrives. It regains momentum faster. So that apart, I think everybody thinks that the world is coming to an end. And for some very few who are in the middle of the war, it might. But for all investors globally, I think in a connected world, we are getting fearful and disproportionately.
Okay. Gold is at an all-time high. So is it time to load up on gold then?
One should look at gold as an insurance. And that from that point of view, you should have 5-10% into gold. But you need to buy the insurance before the accident happens, not after it has happened. Today, you run the risk of catching the market high.
Okay.
So gold surpassed equity fund inflows for the first time, and people stopping their investments in equity, and that too dramatically, half as much. So that itself is pointing to a kind of situation which makes me feel that this might be a misplaced thing.
So if markets are falling, who actually is losing money?
The way to look at it is, it's not that market goes down, your investment values go down. All your SIP accumulation, which achieved which touched a new high, it has gone down in value, but you are not losing money. The value has come down. It is not that your money was lying there and somebody has walked away with it. The quoted price of those investments has come down, and it might remain there for a while. And so if you take your money out, you have booked losses if you bought at a high. But the real people who are losing money are the derivatives traders, are the futures and options investor. It is like a borrowed money which you have invested. You had 100 rupee and you have bought something worth 1000 rupee. And if price goes down by 10%, your capital becomes zero, and then you get wiped out. And those are the people, and we have seen that study time and again from SEBI, that 90%, more than 90% of the people investing in that F&O segment actually lose money.
Moving on to fixed income, nobody's now at this point of time talking about their FDs. Should they?
The fixed deposit doesn't care about the Middle East crisis or the war. They are only supposed to deliver you the promised return. It'll earn exactly what has been agreed upon. Fixed deposits, when you make a deposit, it's a contract between you and the bank that you will earn this much and you'll get your capital on time, and this is the interest that will be payable. And that is the charm. That is the promise. And that is almost always honored. Debt is a shock absorber, and when there is this flight to safety, people run towards fixed deposit, and it's normally the wrong time. If you had to run towards fixed deposit, flight to safety, it should have been done before the market had fallen. Then it would have been beneficial. It is like buying high. After it has slipped, you sell low and then go towards something. And when the markets will turn around, you'll be out of it. I think it is important for investors to remember that asset allocation, rebalancing, that is the only thing you have in hand. And your equity allocation, if it is diversified, and it's important to carry on with your investments today. Because simple secret, buy low, and that is what it has become, not sell low.
So, as an investor, should I actually do anything this week looking at the scenario?
Look at your asset allocation, look at it very closely, look at, think hard about yourself, that how upset you are. When are you likely to need the money? I think these are more important questions than looking at the market, because you have absolutely no control on what happens there. And I'm very confident that with hindsight 5 years from now, we will look at this as an opportunity. All these kinds of situations always look as an opportunity with hindsight, not when you are into it. It's scary. And everybody invests for the long term and thinks that it has to do well all the time. That is not going to happen. This is the nature of the beast, which is equity. It will be turbulent. It is that is what makes it a great vehicle. And investing through these times, investing through such phases, is as important as investing in the first place in equity.
Okay, so the greatest financial literacy lesson, the ability to do nothing when everybody screams, do something.
Yes, in fact, that is the best piece of advice. But most people don't think that it's a meaningful advice. How good is an advice if somebody is telling you do nothing? Because advice has to be about doing something, and not doing something is a very important piece of advice, more so in these times if you're a long-term investor, or if you're onto a plan and you should stay the course.
All right. Thank you, Dhirendra, for
Thank
sharing
you.
your insights. That's all we have for you in today's episode. Keep watching the space for more information. Thanks for watching. Bye for now.